One of the reasons I hate 401k mutual fund accounts and why I think it's a big Ponzi scheme is because you can't insure your portfolio. Most people don't know that you can buy stock insurance for your portfolio, and it's called a protective put option. And you can Google this to learn more about it. In this video, what I want to do is show you an example of me filing an insurance claim on a stock I own that fell in price. So what I wound up doing is like any insurance on your home. I file an insurance claim. This essentially is the equivalent of filing an insurance claim. And I reduce a potential $26,000 loss down to a $230 loss. So let me drop you into that video, and I hope you enjoy. And so what I'm going to do here, I had a 130 put. So what wound up happening here is I wound up purchasing stock at 130. If I sell it here, I have to sell it at 115. So that will show as a loss as far as how TD Ameritrade tracks it. So what I'm going to do is I'm going to attempt to exercise one of my puts. I'm going to, you can't even see this. Let me move this up, see if you can see it in the recording window here. So I'm going to right click here, and I'm going to try to exercise two of the long puts I have. Because remember, a put option, these are protective puts. Essentially, they give me the right to sell this at 129. So I'm going to attempt to exercise two of those there. We're going to hit confirm and send. I'm just going to look here. It's going to show a credit of $25,000, pretty much the money going back in my account versus the $15 is going to take the commission there. So let's go ahead and hit send and see what happens there. All right, you didn't see that, but it says exercise. So let me come here to the account statement there and look at the cash history here. And so exercise two protective puts. Let's say this was just long stock holdings. Let's say you bought, you had your positions, you bought some protective puts for a stock you own. So that was an example of how you can go ahead and implement the protective put. And so you can see I did that with gold, and it wound up putting 25 grand back into my account. Let's see here. Let's see. I bought them for, actually, let me just go ahead and go back a couple of days here and see if it shows me buying the stock gold here. But here, removal option due to assignment, I bought gold for 26,000 because I had to buy it at 130. I wound up selling at 25,800 using my protective put. So 2580 minus 26,000, just a $200 loss. But if you factor in commissions, it's 230. So that's not bad. 230 loss compared to the 2 grand. I think this one was showing that I was at my stock position if I had just sold the stock out in the open market. But anyway, I don't view this as a bad thing. Like I was teaching on one of the live calls recently, view everything you're doing as a learning experience. Try not to attach good or bad to stuff. It's just all learning experience. All right, now I'm back with one more example before I let you go. That previous video was recorded for students of my trading tribe, students that hired me to be their mentor. And what you saw was a good trade gone bad. It was a trade that got messed up on me, but still I used the benefits of options, that protective put option, to reduce my loss. Now here's an example of a trade that worked out. So again, I said I would use this strategy to protect my wealth during a market crash. So you can see here, I bought, what you're not seeing is Facebook. I bought Facebook for at $160. Earnings was coming up. I was concerned that it may crash in price. I wanted to protect myself. So right here, what you see is this protective put I bought right here for $5,000. And then you wind up seeing me exercise that protective put down here to cash out. So this protective put shows it costs 5 grand, but it actually was free for me. And the way I trade, I tend to try to get other people to pay for my insurance. So I use profits from other trades. I strategically structure certain trades to earn enough income to fund the purchase of insurance, because my personal belief is nobody should ever invest in any kind of stocks in the stock market without having some kind of insurance or protection. There's different ways of doing it. It's called hedging. I don't use that term. It's just insurance. You're protecting yourself against a catastrophic loss. And this is what I did here with Facebook. So let's assume this was not a free trade for me. You're not seeing the profit I earned on other trades, but let's assume that it actually cost me $5,000 here. What I want to show you that it's just like your insurance on your home or your car. It comes at a premium. It costs you money, but The insurance on my house, I don't even know what it is. It's paid automatically through my bank account. But let's say it costs $1,000 a year and it's protecting a 200 grand house. Do you think that's a good investment for me? Yeah, because I could not have insurance, try to be cheap and save the $1,000 a year. But if my house burns in, I'm out 200 grand. So that $1,000 is a decent premium for me to pay. So again, let's come in here and assume that this was not free. $5,000 divided by, and actually let's come here. I just realized something. I told you wrong. I bought Facebook at $165 a share, 500 shares, 82,500. All right, so we do that 5,557 divided by my cost basis, how much it cost me, how much am I into this stock, how much I have invested in Facebook. So that insurance represented 6.7% of what I had invested in that stock. But it protected me from losing all 80-something thousand dollars. So again, it's kind of expensive. You're like $5,000 for insurance, but it's either I lose $5,000 or I lose 80-something thousand. And I bought a 170 put. I actually, bought a protective put that allowed me to sell. This is again a benefit of put options. It allows you to sell something for higher than it's currently trading at, because Facebook at this date was not trading for $170. So at the time, around June 12th, I think Facebook was around $158, something weird. Now, for those who don't know how to trade options, this is going to be completely confusing for you. Don't get caught up in all the ins and outs of trading this. You'll learn this over time. But just recognize that even though Facebook was trading at $158, give or take, I was able to come in here, buy a protective put, buy some insurance for my portfolio. I bought a contract that gave me the right to sell my stock at a higher price than everybody else. Yes, it cost me some money, but still I wind up selling my stock for a profit. And of course, insurance was free. But if you don't know how to do that, then you can just look at it, what I just did. That insurance may be 6% of what you had invested in the stock. But if we actually take, and you could look at your true costs here, 84,983 is what went back into my account, minus 82,500 what I had invested in the stock. So I made a $2,400 profit on the stock, but you have to back out the insurance, how much the insurance cost me. So the insurance cost me $5,000. So really the insurance, if it was just you, insurance was free for me, but we're pretending it's you. You don't know how to get someone else to pay for your insurance. You just have to eat the cost of the insurance. So doing what I did here, made a profit on the stock. I sold it for a higher price than I bought it for. So I made a little profit. You back out the insurance. So the true insurance cost is only $3,000. Okay, $3,000 divided by 82,500. Now we've brought their insurance cost down to 3%, which is pretty reasonable. A 3% loss on the stock versus 80-something thousand if the stock wound up dropping in price, which it did not. Facebook kept going back up. And I was not sad that I sold all my shares. I was fine because I accomplished what I wanted to accomplish. My main goal was to protect myself from a major loss. Again, I do not believe anybody should invest in the stock market without having some type of insurance. I've, just like you, have worked too hard for my money to allow the stock market to take it away. So that's why when I hear retirees, people are about to retire, have lost 40 to 50% of their hard-earned savings in a stock market crash through 401ks and mutual funds and all that, I cringe. I feel bad for them because those accounts handicap them. Those accounts don't allow them to buy insurance like this. Those accounts don't really give them any flexibility to make sure they don't lose that much money. And that's my goal. Ever since I've learned options, as far as back as I can remember, I have never lost 40 to 50% of my account in a market crash because of the flexibility that options give us. So you take care. And if you found this video valuable, you think it can help somebody, please share it. And if you want more training like this, just click the link below or subscribe to the channel. Talk to you soon. Bye-bye.